Trading on non-public information is a federal crime. If caught exploiting a corporate tip, you'll likely leave your office in handcuffs. These laws were built to protect the individual investor, theoretically ensuring that the person at a home computer has the same access to material information as a hedge fund manager. But Wall Street has engineered a workaround. By deploying AI to ingest billions of data points, from private credit card swipes to encrypted supply chain logistics, large funds have built a parallel information stream under the label of advanced analysis. Because this data is technically alternative rather than internal, it avoids legal scrutiny. But when a machine trades on private movements that the public cannot see, it creates the exact same informational advantage as a whispered secret, making the traditional definition of insider trading functionally obsolete. Most retail traders are still looking at RSI levels and moving averages, trying to find a signal in historical price patterns that everyone else can already see. While those traders wait for an update, institutional satellites are already overhead, tallying every car in a retail parking lot to calculate quarterly revenue weeks before the company reports its earnings. This creates a permanent informational monopoly. The machine is trading on the physical reality of the world, while the public is still reading last week's news. Attempting to compete with these data flows using only a basic chart is like bringing a knife to a nuclear war. Imagine a CEO quietly preparing an unannounced resignation. They board a private jet at midnight, thinking the move is invisible. Algorithms track that tail number across a digital map, registering it intersecting corporate headquarters at 3 a.m. The AI cross-references this with panic scraped from Discord, instantly executing thousands of trades, shorting the stock based on this alternative data. The informational monopoly is complete. The trade is finished before a press release is even drafted. Hours later, you receive a breaking news alert on your phone. You see the CEO's resignation and think you're early to the story. You rush to your brokerage app, panicked and eager to react to what feels like fresh information. But by the time you can even type a ticker symbol, the market has already moved. The price has adjusted to the new reality because the machines have already extracted the value. The AI didn't predict the future. It simply saw the present moment and acted while you were still blind to it. In this system, the individual trader is no longer a participant. They are a resource. Algorithms identify the exact clusters where retail traders place their stop losses. They drive the price down just far enough to trigger those sell orders, consuming your liquidity before immediately reversing the trend. To the automated shadow market, you aren't a competitor. You are breakfast. Modern finance has moved beyond human biology. It operates at a scale and speed that exceeds the limits of how our brains process information. Fighting a high-frequency bot with human emotion and 20th century technical analysis is a statistical dead end. Survival requires a shift in perspective. You have to stop viewing the market as a human auction and start seeing it as a machine-driven ecosystem. Success in this environment is reserved for those who can navigate the reality the algorithms have already created. This is the rise of the Solo Quant. You don't need a PhD or a billion-dollar server room to adapt to this new landscape. The objective is no longer about predicting where the price should go. It's about mapping the data flows of the machines and moving in their shadow. You have to learn to see the world through the same sensors the bots use, identifying their footprints before they vanish. The game hasn't just changed, it has moved to a different dimension. To trade in 2026, you must learn to see with the machine's eyes, because in the kingdom of the blind, the one